This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Help attract more borrowers and build a more resistant loan portfolio. Payment Guard Insurance from TruStage is a first-of-its-kind insurance solution designed for digital lenders to do just that. Visit www.trustage.com/payment-guard to learn more and talk with a member of the TruStage team. Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson. This is not fintech investment advice, which means that the great and powerful Simon Taylor, author of Fintech Brain Food, joins us once again. Mr. Taylor, how are you?
I'm really well. Glad to be back. How are you?
I am delightful. It is semi-British weather here in Montana. We have some rain. It doesn't rain here very often, Simon. So whenever it rains, I'm put in a very different mindset. And I'm wondering if it's the mindset that you're in all the time. Like I feel smart. I feel
I was just going to say, welcome to my whole life. It's kind of like, this is why we're a little bit sarcastic, stiff upper lip. You're just kind of going to get on with it, kind of melancholy. And that's why you need a sense of humor. Where do you think the sense of humor comes from?
If you had to put up with this all the time, I could see how a sense of humor would be critical. So, okay, we'll be channeling that sort of sarcastic, sort of biting, stiff upper lip sort of energy. That's like what we're bringing to the podcast today.
Yeah, maybe, but I'm not a very good Brit. I get really enthusiastic about stuff. I don't know if you've noticed.
I have.
I'm surprised they let me live here, frankly, at this stage. I'm more optimistic and hopeful. It's really annoying.
It's weird. Well, you should come out west. That's, we're like pioneer stock out here. Like I probably wouldn't have made the trip all the way out to Montana like my ancestors did, but they were very optimistic people. So we'll turn away from the pessimism and the cynicism and embrace optimism as we normally do for this podcast, Simon, because as we always do, we're going to take turns talking about fintech companies that intrigue us. And at the end, we will, as always, try to manifest a couple of ideas for things that we would like. Simon, as my valued guest and co-host, I will allow you to go first.
Well, thank you so much. The first one is called Modak Makers. This is a family banking app that might actually work. So it's an app for kids with a card and teens. It's a card for kids and teens with no monthly fees with an app.
Okay.
You can have teens as well.
That's fine. I don't personally, and I don't understand teenagers, but we'll get there.
I don't understand them. I barely understand cards at this point. But what makes it unique, it's reward systems.
Okay.
So they call them Mobucks. You want to get Mobucks? Yeah, you need Mobucks.
Yeah.
And that's given for doing chores. It's given for sensible savings habits, weekly challenges. And they're even going to give it for things like step count. And bit of me's thinking, isn't that parenting anyway? Just incentivizing teenagers with money to do the thing that you want them to do with that. But I like the structure of it. I like that it's thinking about it. I do wonder about making every kid nervous about hitting their daily step count versus being a kid.
Right.
But there are so many meh companies in this category.
Yeah.
It's a card and it kind of works, but they never go on to be something I would actually love to use, something I would get excited by. And I always get scared when I see reward feedback loops, but actually this feels like it's done with really positive subjective intent. And so I really, really like this concept. Might be a smidge pushy, but how many people graduate college not knowing how to manage their money? This is definitely a giant problem, but it always felt like this app category was a niche and it was going to stay niche and it was going to live in that niche. And there are nice businesses to be built there. There are very nice businesses to be built there. But in here is the nugget of something that really got me intrigued. Thoughts?
Well, I like it. I will say that I generally agree with your take on the category. I mean, the thing I think about a lot with this is if you're just building sort of the generic family banking app with a debit card, with some built-in card controls, a couple other sort of standard features, are you really that different from what Apple has added to the Apple Card or
Exactly.
what Cash App has added to Cash App. Like, if it's not more than that, it literally is just a feature in larger ecosystems that already exist that are going to add this. And that's already been happening. So I think that's a really fair point. And the other thing you said that intrigues me is this idea of like subjectivity, right? And I think your point's a really good one. You have to strike this balance whenever you're designing a product between sort of leaving it unopinionated and open to users and not overly like pushy or prescriptive versus being prescriptive, being subjective, having an opinion about how this should work. And I think every category is a little bit different here, but I generally come down more on the side of you should build something that will work extraordinarily well for a smaller set of users because it's opinionated and because it does things from a point of view and a perspective, even if that means that to others it will feel pushy or overly prescribed or whatever. Like, building something that's kind of for everyone means it's not really deeply for anyone. And, you know, I think that in this category, we need more of that type of thinking. So I'm definitely intrigued. I will add one additional thought, Simon, which is, and you might not be quite there yet in terms of the age of your kids, but I have a kindergartner and it is what it is because there's definitely been an element of, I think the first thing we gave him was like, hey, you know, help us with this thing and we'll give you $10. And not really thinking at all. And he did it, and he did it enthusiastically. He actually did a pretty good job. Then he got the $10. And then every single time I asked him to do anything around the house, he was like, that'll be $10, which did not go well because I'm like, dude, you're going to bankrupt me. Like, that's not going to happen. I know that's not how this works. And so we had to sort of, my wife and I, completely refashion like basically like an ecosystem of like chores and financial incentives. And it touches on something you were saying before, which is you want your kids, and I imagine this is the same for teenagers, although I'm not there yet, like you want them to do the things that you want them to do just because it feels right to them. Like you want it to be an intrinsic motivating sort of thing. But as with all humans, and kids I think are particularly this way, you sort of have to give them scaffolding around that thing so they can develop this like habit and this behavior that eventually just feels good intrinsically, but at the beginning you have to sort of scaffold around it. And so I've been getting sort of an up-close view of just how tricky it is to build that scaffolding around these behaviors. And I am really intrigued by apps that would have an opinionated design and maybe some like science and research kind of built into it to help me navigate that scaffolding process, because it's way harder than I thought it was going to be. My only experience with this is on the other side when I was a kid and I had an allowance, and I never really considered just how tricky it is as a parent to design those reward systems. So that's the other part that kind of tickles my brain here.
So much of it is about great engagement and great game design. Like, great game design is really about giving people the scaffolding to discover the intrinsic reward. Like, it should feel good, but how do I figure out, okay, so I push this button, oh, it jumped, but it comes with a little set, whoop, you know, like there's always the, how tight can I make those initial feedback loops? So some of the features here are really nice, like daily rewards. If you are saving on a daily basis, here's that daily reminder that you've done something useful. I'm going to activate you. I'm going to send you a weekly challenge and you're going to get some Mobucks for just answering a question, like a little quiz thing. Oh, that's valuable. You know, like it's building engagement in really interesting and unique ways. So I kind of like that they have an opinion on it. And there is an attempt here to make it, to drive towards the intrinsic reward. And that's exactly where my head went. Like, it's really been thought about. Will it work? Don't know. Good question. But I'm with you on the behavioral psychology.
Yeah, I'm completely on the same page. I mean, it's nice to see that type of thinking being built into this. Who knows if it makes sense or will work for everyone? Probably not. But it seems like it's moving the ball forward in this category, to your point.
And I think the other thought when you mentioned like Apple, the family version of that, and where some of the wallets are going, like Square, like ultimately, I think this is R&D for everyone else. Like, you can learn a lot from how these guys are doing it, but can you build some of that rewards feedback loop this tightly aimed at this generation of people? This is where an opinionated product could really work. And maybe this is just the best one of those in the niche category, but still, the point you were making about unless you're for somebody, you're for nobody, there's a great blog post called The Tyranny of the Marginal User, which is, that thing that you do to make it work for that one person, that one place, that just make it acceptable to everybody. And the marginal user doesn't really care about your product. They're just being engaged because you forced them to be engaged because you got big. And this is where you end up with those big generic things. Apple finds this line really well by stripping things away from the product, by making everything justify its existence. All that does is it creates space for something else at the other side of that is more opinionated. Gmail versus Superhuman. Like, there's a difference between those two products, and there's a value creation when you are more opinionated. But there's a question about how big do you get and how big do you want to be? I'm so glad. One little sidebar on this. This company has some of the most conservatively written FDIC disclosures I've ever seen.
Really?
Hashtag scroll to the bottom on this thing. It's Makula rule compliant as much as you could possibly be for a relatively young company. It was just, Modak is a financial technology company and not an FDIC insured bank. And so funds deposited into checking may be eligible for up to $250,000 of FDIC insurance. The FDIC's deposit insurance coverage only protects against the failure of an FDIC-insured depository institution. So there's wow, really, really, I've never seen 5 lines be that clear in a disclosure ever before.
No, that would actually make seemingly the FDIC happy, which is not an experience they have a lot when they're scrolling to the bottom of a lot of these early stage fintech companies.
It's a sign of the times we're in. I think Jason can take a lot of credit for this, but totally. Actually now the fintech nerds are looking for how good's your disclosure game, dude?
Yeah, right. No, it's very true. And I mean, I think early stage founders are building this in as a line item in their budget. We have to nail the marketing and the disclosures on day one, which is very cool to see. I applaud the industry for sort of moving in that direction. And, Jason and the FDIC for sort of prodding from behind. It's where the industry needs to go. Simon, can I give you my first company?
Oh, please do. I'm excited for this one. Hit me.
Okay. This one is very early stage. In fact, I couldn't even find a website for these folks, but I did manage to meet the founder of the company at an event that I was at in New York. And so the company's name is Casap, CASAP. And what they do is essentially customer-centric chargeback and dispute management, right? And so the basic principle is that much in the same way that someone like a TruAccord has sort of taken a different approach to collections, these guys are trying to apply sort of a similar type of thinking to chargeback and dispute management. And so the way I've been kind of thinking about it is, if you look at financial institutions in the US, card issuers, they sort of sit on this continuum of how customer-friendly do we want to be? And on one end of the continuum, there's credit unions, right? And credit unions are, for whatever jokes bankers want to make about credit unions, generally they're very obsessed with their members and making sure their members have the best possible experience. And they're just very member-oriented. And I think that's genuinely true. And what's interesting is if you look at the way that member centricity sort of manifests itself within the chargeback and dispute management process, what you will find is generally a process that is extraordinarily pro-member. So you initiate a chargeback or dispute, they make it really, really easy. They throw lots of people at it to make it this nice white glove service. They never, ever really push back on you or question the validity of this. They don't really worry about fraud at all. And as a result, it's a lovely experience for members. And it is also a lovely experience for fraudsters. And credit unions tend to lose a lot of money on dispute and chargeback fraud. They tend to have a very high sort of set of operational costs around that process. And that's the cost they pay for being very member-centric. On the other end of the continuum, you have some banks. And I'm not sure what category of banks would be most likely to be on this end. I think a lot of the large card issuers, just because of volume, are probably on this end of the continuum, probably some regional banks as well. But these banks take basically the opposite approach, which is we're going to presume that you are guilty until you prove that you're innocent. And so they have a very rigorous process. Generally, it's very sort of highly automated. There's lots of steps that get thrown in the way. The process takes a lot of time. It's difficult to actually get to a human being to talk to them. And as a result, they manage to basically like screen out almost all fraud. They have very low rates of fraud. It's generally a very like operationally efficient process. But as a consumer, as a customer, you feel like you're going through a meat grinder trying to just get a refund or a chargeback for this like legitimate problem that you had using your card. And so Casap's sort of general philosophy is, I think everyone should live sort of in the middle of this continuum. And the way to do that in terms of how the technology works is we're going to try to sit at the front end of this process and provide really good predictive analytics to guess with an extreme amount of accuracy which of these incoming transactions might be likely to be fraudulent if there's a chargeback associated with it. And so they try to get really good at guessing at the front end. And what that means is downstream of that, they can be very targeted in the way they treat different chargebacks or disputes. And so the idea is if we have a high level of confidence that this is fraud or this is not a legitimate chargeback or dispute, we're going to send it down this path, and it's going to be highly automated. It's going to be sort of unpleasant to deal with, and we're going to require a lot of proof, and we're going to sort of go through that process. We're going to try to minimize our losses. But if we don't believe that it's likely to be fraud, we are going to send it down a very different path, a very customer-centric and customer-friendly path, and we're going to try to use this as a way to build loyalty and build sort of a stronger relationship with our customers. And Simon, I think the thing I like about this is just you don't tend to see this type of nuanced, sort of dynamic, analytic-driven thinking in these areas, right? You tend to see it in marketing, you tend to see it in customer acquisition, but on back-end sort of service-oriented processes like dispute management, collections, a lot of customer service tasks, things are usually treated in a very binary approach, like either this is our operational philosophy or this is our operational philosophy, and there's no sort of room for nuance. And the thing I like about this is it leaves a lot of room for nuance and for charting out different paths that people can go down. And I don't know, I was thinking about this broadly in the context of how financial services companies are going to compete in the future when, just generally financial services is more sort of fungible. It's easier to move from one to the other. People have multiple bank accounts. Like, in that environment, I think a lot of times the things that are going to determine what card is top of wallet, it's going to be small things like they never hassle me with disputes ever. Like they give me a Costco like over the edge of, wow, this is actually a really, really great experience and I'm going to use this card. So I think the world is kind of moving in the direction of needing more of this stuff. And I was intrigued. What are your thoughts?
Soups calls this fast lane and slow lane. And I think there's more to it than that. There's multiple lanes. The other soundbite he has is a little bit of friction can be a good thing if it's warranted.
Yeah.
And
yep.
The question you have to ask, is it warranted and how do I know? So in the US, it's quite common now for a fintech company to have progressive KYC, which is if you come in the door and you look kind of low risk, then you can just enter a few data points, do a quick selfie and a liveness check, and you're kind of in. You don't even have to get out a document, scan a passport or whatever. In the UK, in Europe, like you have to scan a passport no matter what you do. So, you kind of have this progressive KYC concept. But the progressive KYC also goes further. It goes into and after the customer's in, you set sensible limits about how much they can do. So they've got a virtual card. All right, I'm going to limit you to $100 transactions because I don't know you yet. And I haven't had a card delivered to your house. So I don't know if you're really where you say you are. So I want that extra data point. I want to know, are you just going to try and drain this? Are you going to be a fraudster? The highest risk is, or a lot of the high risk is right up front, just after the account's been opened. But also, if I'm going to activate you, I want you transacting as soon as possible. So onboarding is such a conversion issue, but you also have conversion issues and service issues throughout the life cycle, right? And I think that's such a good way to think about it. So as I was thinking about progressive KYC, I wrote down progressive friction at different points in the customer life cycle. And ultimately, really, you're trying to figure out, what's the context around this interaction? And is it good or bad? And therefore, how much friction should I add? What's the context that exists around the way they're behaving, the transaction, whatever's going on. And another area for that is scams, right? Like you're seeing people get asked 20 questions now in the UK before they can make a payment to somebody because there are so many scams. It's like, well, how confident are we? And do we need to add that friction? Because now we're just breaking things and we're defaulting everybody into the slow lane.
Right.
So fast lane, slow lane, I think is one thread to absolutely pull on. So a long way of saying, I agree, it needs to apply throughout the life cycle. But I think the other thread to pull on is, are we philosophically delivering a service like a credit union, or are we philosophically selling a commodity? And I think there are still good answers to both sides of that. And some customers will buy on price. In a world in which, as you were saying, top of wallet can be reaggregated and I go to wherever the service is best and the account is a paycheck motel, as Ron Shevlin would call it, then you do need to compete on service. But I think a lot of financial institutions, either their consumer book is already unprofitable and it's just a source of sticky deposits, and they're not thinking that way yet in terms of service, or that they've got enough older customers that they're not as worried because the older customers are profitable, as a bank would say, it sits inside of our window. Whereas the younger customers that might be tomorrow's profitable customer, oh, we're not interested in those. We'll let the Chimes and everybody else have at it. Like we don't care about that. So it's a difficult one to say, like, how much should you care about service? But I think your point that I didn't hear you say, but I think is the correct one, just the market shifting and service will become a battleground, but you're going to have to do that without just adding a load of cost like an Amex would. You can't just be the premium brand. You got to figure out how to fast lane slowly.
Yeah, no, exactly. I mean, I think that's a really good way of describing it, right? Is that how do you win in a world in which customer service becomes a dominant sort of metric on which customers make choices without having the resources of an Amex? Like that's kind of fundamentally the question that I think a lot of banks and credit unions are going to have to wrestle with. And, it's interesting you were talking about sort of the different philosophies around this stuff, because I think for a long time, it was just like, yeah, we have a credit card, like we know it's not really as good as, Chase or Amex or, Capital One or whomever, but we have a card and some people use it and it's great. I kind of think like a lot of that is going to get squeezed out of banking. And you're going to have to make much more deliberate choices about what products do we want to offer and why do we think we can win in those product categories. And, some of the ability to win is going to be defined by scale. And obviously, like in credit cards, rewards and just sort of the ability to apply scale to these products can make a huge difference. But I do think there will be opportunities for more sort of subtle points of differentiation, but you're going to have to care about it. And so I do think that is a big part of it. The other thing I was wondering about real quick on this one is, I've talked to a lot of banks, big, small, over the years. A lot of them sort of pretend to do this, but I don't think very many actually do, which is I would like it if on an individual basis, a bank could dynamically in real time basically adjust my experience based on their sort of internal score or ranking of how valuable a customer I am. And, the traditional banks will do this when a private wealth customer walks in the secret side door to go in and talk to their private banker. But in a digital context, the infrastructure doesn't really exist to enable that. And that's the other thing I was thinking about with this is you'd really want to weigh how you treat customer service interactions, disputes, chargebacks, just sort of people calling in with questions, whatever, based on the value that the customer provides to you as an institution holistically. And I could see that becoming a huge metric over time where it's like, hey, Alex is a 98 out of 100 for us. And so unless this is like flashing red light, he's like trying to launder money or he's, trying to initiate like some first party fraud scam. Like, unless we're 100% sure, we're going to default to trusting Alex and giving him the best possible experience. And I don't think that level of, again, like nuance exists within the systems that banks have today, but that's the world we're headed towards.
Banks fundamentally segment customers by product. and the P&L is run by product. So if you've taken a mortgage, you're as profitable as your mortgage is, and they all have the project to create a single customer view, but chances are most of your banks have 10 different Alexes that they think they have, and they're counting them all as more than one customer. It's just how financial institutions in the US, the top 5 financial institutions collectively count something like 700 or 800 million consumers. And I'm like, that's twice the population of the United States. That doesn't make any sense. It's because you're double counting, right, across multiple products. And so if your value is only driven by product, you don't have a single customer view. The amount of like Salesforce implementations I've seen that was going to deliver a single customer view that haven't delivered a single customer view. And the issue is very rarely the CRM. It's the ability to get value out of your existing systems and your product thinking, your product-led thinking. Like fundamentally, financial institutions manufacture and distribute financial product to customers rather than customers have problems and we can create value by changing the products kind of around them. Now, changing a UI around somebody and a mobile app is a little bit different. But if you unlock tiers or if you unlock access to things, that's entirely doable. We see it with subscriptions, right? Like I pay the $10, I pay the $20, and I get different benefits. It's like that classic SaaS page where they want you to buy the one in the middle. Like we know how to segment products by the price somebody's paying, but we don't know how to do it by the value they create. That would be entirely possible if you had sort of a modern digital backend and you could run the analytics. Like if you have BigQuery and Bigtable somewhere inside your consumer fintech, you can figure out how much, or at least I hope you can if you've got a grip of your unit economics, you should know how valuable that customer is and you could make that decision accordingly. And you could segment based on how much cost is this interaction going to be and how much value is this customer and make a fast lane, slow lane decision. Like, yeah, this is eminently buildable.
You just gave me an idea for a future post, so I'm not going to spoil it here, but that's an interesting thread to keep pulling on. I will gavel this one off. Simon, your second company, please.
Gabbled off it is. This is Silver. So they are HSA and FSA expenses as a service.
Oh.
So yeah, right. So there's a whole bunch of discounts. I didn't know what an HSA or an FSA was, but turns
you
out...
silly Brits, they're a way we solve problems with tax-advantaged things that really doesn't make any sense in a public policy context. That's what they are.
Well, I didn't realize as well that most people don't actually bother claiming them or they miss out because when you're going to buy prescription stuff, you know, sort of your Walgreens, your Targets, your Costco's, wherever, then you need to figure out, is this prescription that I've gone for, is this thing that I've gone for actually eligible for my provider? Well, turns out if you just scan your receipt with Silver, it'll analyze valid expenses and submit them on your behalf. Done. So now you're sort of getting that like modern spend management B2B like experience, but just for taking a photo of a receipt. Now, Silver charges 4% of any eligible expense it finds. So on average, the expenses it finds in a given year would be $325. They say this on the website, which is kind of cool. So that makes an average of $13 of average revenue per user. There are 72 million people in the US with an FSA or an HSA. So a 1% market share would be 9.4 million ARR. Or if they had a 10% market share, that's 94 million. So if they can make this experience great, there is revenue there to take. But imagine if this was an API everybody could use. Like, I love this product, but it feels like a really great signal of a feature most apps should have, most consumer-facing apps should have. Like, why isn't this a feature in Chime? So every time I see like a wedge fintech company, I'm like, that's a great feature if it was an API. And of course, you know, famously, Plaid starts that way. They tried to build a PFM and everybody wanted to buy the API. And turns out, they did okay. So the problem, of course, with these things is distribution and product market fit, and you need a proof point and so on. There are a bunch of reasons why you don't just do the API play. I get that. But thoughts?
I love it. I think that it reminds me a lot of Paribus, which was the sort of credit card find money back expense scanning app that the founders of Ramp built that was acquired by Capital One. And that, I think, is a really interesting point of comparison for this, because in that case, and there were a few different apps that were doing this, but if you remember, there was always this like, hey, you bought this thing, find a lower price and then submit a difference and we'll reimburse you for the difference, right? There was this price protection benefit that was built into a lot of credit cards. And as is the case with most benefits on most products, the whole idea was, hey, this sounds great, but you're never going to do it because it's too complex and annoying to do, that we're just going to be able to offer this benefit, but the breakage on it is going to be like 90%. No one's going to do it. And so we can afford to offer it. Well, all of these apps suddenly appear to automate the process of scanning your receipts and then automatically filing for this benefit to then get you money back from your card issuer. Well, what did all the card issuers do? They all canceled or capped this benefit, right? Because they're like, oh, now people are actually using the thing that we offered. We can't allow them to do that anymore. And so fintech sort of broke that benefit within the sort of wider sort of credit card landscape. Here's the difference, though. In this particular case, that's not how HSAs and FSAs work, right? They're not designed to be a benefit that no one uses. Now, they're not used because they're complex and people don't know how to do it, and there's a lot of paperwork. But there is no one at the end of this going, wow, if you get to 100% usage of this benefit, we can't afford it anymore. We have to cancel it. Like, these are tax advantaged accounts that work in a defined way across a defined set of categories. And so while there is some provider on the back end, some insurance provider that's going to lose out on some money here, that's not something they can do anything with, right? So this isn't a benefit that if you optimize it, it's going to go away. This is just a benefit that if you optimize it, more consumers are going to benefit from it. So I like applying that model of, hey, we can apply technology to solve all the things that make this painful for consumers to do to increase its usage, but this isn't going to break the benefit on the other side of it. And so I think it is very durable in that sense. I think that you're exactly right. To me, I don't know how you build a consumer-facing business out of this. It would seem really hard to me just because I don't know what your wedge is to go acquire customers to do this. Maybe you could do it through employers. That might be a strategy. But to me, I very much agree. This should be built into any app that has visibility into your transaction history. And particularly with the expanded ability that we have via open banking in quotes, because this is like the broader universe of open banking, we're now getting consumer permissioned access into Amazon accounts and Costco accounts and all of these different like places where these benefits might be able to be found. And so you can get consumer permissioned access to get great visibility into like item level data for shopping in these areas. And so I think the infrastructure now exists to enable this at scale, which it probably didn't 10 years ago. So this does feel like an idea that's time has sort of come.
Completely agree. Excited to see this try and get a wedge of users, because I imagine there's a small bunch of people that are really annoyed by that admin of having to submit these expenses and feel like they're missing out, especially just after tax season, right? Like, it's like, could have got this advantage. I don't know what the go-to-market is for those people to really get them excited. But whatever it is, it might be via the healthcare companies. I just don't know who the first best customer for this is and who's going to download an app just to do this.
Yeah.
If they're out there, I want this to succeed. And I want this to exist. I could imagine an experience where you make this transaction and there's a little pop-up notification in whatever card you use, mobile app, saying, hey, keep the receipt. Remember to take a photo of that. You could be getting a tax advantage. You click the notification, up pops your camera, you take a photo of it, boom. Oh, yeah, this is filed away for you. You'll end up with a $6 discount at the end of the year or whatever it is. Woo, okay, I just saved $6 because I got a notification on my phone. I took a photo of the receipt, and now I can throw that receipt, I can toss it, I can do whatever. Like, it's just done. It's dealt with. How do you make this as aggressively frictionless as possible from an experience standpoint?
TruStage Payment Guard Insurance is a first-of-its-kind insurance solution built for digital lenders, designed to help you attract more borrowers, strengthen your loan portfolio, and reduce time spent on collections, all with minimal tech lift needed to go live. To learn more about Payment Guard Insurance, visit www.trustage.com/payment-guard and speak with a member of the TruStage team. Yeah, I do feel like there's a user interface layer that needs to exist for consumers, which is we are going to take in all of the annoying data, receipts, interactions, transactions that are just like a bitch to deal with. And we're going to process all of those and then on the back end figure out what this means for you and where you can save money or time, right? Like there needs to be that interface layer. And there is now for corporate spend management, right? Like that's what we're building in that space. But from a consumer standpoint, there's still so much of like, oh yeah, if you have the time and mental energy and enthusiasm to wade through all these receipts or paperwork or whatever, then you can totally get benefits and you can sort of optimize your finances and your time. And if you don't, your life is going to sort of suck. And like there's no like software interface layer that exists between consumers and all of that manual work. And so I do feel like, to your point, someone needs to build that interface layer and someone needs to build all of the optimization engines on the back end that figure out, okay, how do we get money for people with HSAs and FSAs? How do we optimize their taxes throughout the year? How do we help them pick up extra benefits that they may be qualified for in this other area? So it's like there's a set of back-end optimizations that need to be very tailored to whatever area you're trying to squeeze value out of. And then there needs to be that interface layer that makes it easy for consumers to interact with all of those optimization engines on the back end.
Completely agree. I want this to exist. Whenever I see something, it's incredibly niche, and I guess you kind of have to be to get started. And I wonder where the wedge is for consumers to really make this happen and make it happen in the first place. It gets acquired by a TurboTax, or H&R or whatever, and it becomes like the tax season thing over the top. Is that when it really hits crossover? Does it belong inside my consumer wallet? I'd love it to sit there because I think it has more permission there.
Yeah.
To your point, like if you've used Ramp, it's night and day to anything else on the consumer side. It's so different.
Yeah.
And so, like, I want that. I remember speaking to Eric and saying once, would you ever do consumer? And he's like, well, no, because the consumer protection side is so much more challenging to deal with on even just some of the things you'd want to do with data that a business, you can just sort of get on with it because you're doing it on behalf of that business.
Yeah.
And I do worry, just as a bit of a sidebar, about some of the CFPB's move towards regulating wallets. Like, I get it. They need looking at, and there are some problems there. But at the same time, just, we're going to lose out on some of the innovation if we're sort of always making consumer dangerous territory. Like, there should be a way to innovate over there.
No, I think you're exactly right. I mean, I'm glad you mentioned that because it's a thing I think a lot about with the CFPB. I mean, there's an end state that I don't think is ideal that we could arrive at, which is we've protected the consumer against any bad thing that could possibly happen. And in doing so, we've left them stranded on this desert island where they have nothing that they want, right? It's like, congratulations, you're safe. And it's like, yeah, I'm safe, but I'm on a desert island with no food or shade or shelter at all. Like, great, you know? Whereas you're right, in the B2B side, the sort of mentality is companies are sophisticated enough to protect themselves and to manage their liability and to manage their data and to negotiate well. So we don't have to worry about protecting them, but that unleashes a lot of innovation for them to take advantage of. And you don't see that same dynamic on the consumer side. So I do hope that is a strain of thinking that exists within the Bureau, because that is the outcome I want to see in a safe way for the consumers as well. Simon, can I quickly give you one last company?
You absolutely can. Please do.
Okay. So my last one is a company called Elpha Secure. And what Elpha Secure does is cybersecurity insurance. And cybersecurity insurance is obviously a big area. It's a growing area, given the number of like cybersecurity attacks and vulnerabilities that have been discovered. It's kind of a seller's market to sell insurance into that space. However, as with all things insurance, It's also a very dangerous area to sell into because if everyone is asking for insurance on this thing, means there's a lot of risk associated with offering insurance in that space. And so the part of the market that Elpha Secure has identified is small businesses, which have the same sort of cybersecurity risks on a smaller scale, but still the same general sort of risk parameters that larger businesses have. The difference is that small businesses, in the same way that they are for lending or anything else, they're very, very hard to underwrite for cybersecurity insurance because as the insurer, you just have no idea how good this business is at managing their information security, managing their data. Like, you just don't know. And the worst possible thing would be to, agree to a cybersecurity insurance policy with this company and then find out that the way they manage all of their InfoSec is a guy named Bob who works down the hall. And there's just like no other like controls or programs or software in place. So how do you ensure...
There's a guy named Bob if you're lucky with some businesses, right?
Right.
Like,
yeah, I mean, in a lot of cases, it's like, oh, I'm the owner of the company, and that's one of the 19 hats I wear, is I spend 5 minutes a month thinking about information security, maybe. Or maybe I don't think about it at all. Like, that person needs good cybersecurity, and they probably need cybersecurity insurance as well. But how do you do that? Like, how do you attack that market? So the approach Elpha Secure has taken that I think is really interesting is they basically bundle the insurance together with software that helps manage cybersecurity. And so essentially they provide the software for the business to use to manage InfoSec and to manage some of these cybersecurity risks. And then if they can confirm that that software is implemented, installed, running in the right way, they will then bundle that together with cyber insurance. So essentially, they are insuring companies that are using their own product. And the thing I like about this in a broad sense, the thing I'm kind of curious about is, InsurTech has not worked, I don't think, the same way that Fintech has worked. Like, insurance is just an incredibly difficult market to disrupt. There's all these sort of larger reasons for why that is. But philosophically, I'm very intrigued by the idea of enabling more manufacturers of products to offer insurance that aligns their incentives so that if you're confident that you're giving someone a product that's going to minimize their risk when they use that product, you should be willing to insure that risk and profit from the ability to sell insurance. And this is one of the only examples I've seen of sort of a small startup taking this approach to doing this. Now, you see this a little bit with like Tesla selling car insurance, which they do in a couple of states. You see this with Quip offering dental insurance because they make toothbrushes, that kind of stuff. But on a smaller scale, I wonder if there's a way to package insurance with the product that's being manufactured by a single provider very early on in the journey as a way to sort of unlock some of these markets. So it just seemed like kind of an intriguing model and one that I hadn't seen a lot before. What are your quick thoughts on that?
I've seen embedded insurance a lot. I've seen a lot of companies that do insurance as a service so that they let you embed it. The API providers that have a deal with the carrier, and they're helping fintech companies, non-banks embed insurance at your point of sale or wherever. Like, that's a thing, and it's out there, and it's finally growing, and these companies are hitting Series C, and we're getting there. But you don't see it in the long tail. You don't see it inside a Shopify.
Yeah.
And that's kind of interesting. But it's like that Shopify merchant that's got a few customers, it's that smaller business. I worry about trying to go after the really long tail here. Like,
there's a small enough level where it probably doesn't make sense, right?
Yeah, but, well, not even small companies, but like mom and pop, Heartland America, like the companies that are still running Windows 95 somewhere, you know, that have one office computer. Like, there's plenty of those. So how far down that spectrum do you go? Versus there's a trend, I don't know, there were two trends that came to my mind. One was device as a service.
Yep.
There's a bunch of companies that will set you up with your fleet of digital devices, and they'll be your in-house kind of fleet management plus cybersec team. They help you manage all of that. often they have a level of insurance, but are they able to repackage that insurance and cyber risk insurance for that business? No, they're not. And they're an interesting distribution route. The other one is asset financing. Like, actually, a lot of the regional banks and smaller banks, that's a big line item of lending for their businesses, right? Like, if I'm financing your asset, why aren't I insuring it from cyber risk as well? So yeah, like asset finance could be financing your fleet of vehicles. It could be financing all sorts, but often it's office equipment and often it's digital office equipment. And so there's cyber risk in there somewhere. So I could see a couple of interesting distribution mechanisms here. What it was not obvious from your description is like, who's the ICP end buyer of this? Like, what's the ideal business profile look like, ideal client profile at the end of it? Because I could see distribution routes and I could hypothesize who the perfect sort of customer might be. Somebody who's reasonably digitally savvy, but not got cyber insurance, not going to be sold it by anybody, but they absolutely need it because, oh my God, small and mid-sized businesses are low-hanging fruit for just about every kind of criminal at this particular juncture. So yeah, business is good for the criminals.
It is. Well, and to your point about the ideal size of the customer, one of the thoughts I have, and this is completely like unformed, unscientific, like intuition, but I've been sort of noodling on this concept of we have a really good feel for, when we think about the commercial market, large enterprises, which we know, there's lists, we know the brands, like we recognize what that looks like. And then on the other end, we have this sort of popular idea in our heads of small businesses, mom and pop shops. And we sort of know like intuitively what that looks like. But I think in the commercial space, the mid-size market, however you want to define that, there's lots of different ways to kind of cut up the market and segment it. I think there are way more of those businesses than we think. And I think that they are pretty underserved, generally speaking, because, a lot of the systems that we build, whether it's Shopify or Square or what have you, those are designed for like true like mom and pop. So they sort of scoop up the very bottom of the market. And then obviously we have a whole bunch of people who want to cater to the very largest companies. But I do think there is this very large and sort of squishy, undefined middle in the commercial space where there's a lot of room. And it's funny because you and I just did a podcast on this. It's going to be coming out later on sort of how to serve the commercial market. But there is, I think, a segment of that middle that's being better served now because fintech is going after startup founders. And I think startups oftentimes sort of sit in that middle. But that's just one slice of this large sort of, amalgamation of middle-sized companies. What do you do for, just making things up off the top of my head, like a construction company that has 120 employees spread out across 3 states in the Midwest, right? Like, that's not an enterprise company in any way, shape, or form, but it's definitely not a small business in a mom and pop sense either. There are a lot of those in the US, and they're not particularly digitally savvy, but they are big enough to be both a threat and an opportunity. And I think there is a way to get to those. Now, to your point, distribution is hard. I think Elpha Secure is sort of thinking about maybe going through community banks as a mechanism to reach some of those ones because they're close to a lot of those companies. But I do think that market is quite a bit bigger than we sort of imagine in our heads. And even sometimes when we break it down by numbers, I think it sort of misses the opportunity there a little bit. That's an intuition. I might be totally off base.
That 10 to 50 million in revenue, sort of 100 to 250 employees, that sweet spot is underserved, hard to distribute to, needs digital products, but they're the frontier at the moment. This is what a lot of products and packages are trying to get at that. They're trying to take digital into the atomic world. And since the pandemic, that's become like a default for a whole bunch more people. So why not?
Absolutely. Simon, before I let you go, can we manifest a couple things?
Please, after you, sir.
All right, I will go first. So my idea real quickly is a show me my price browser plugin. Okay. So the concept here is that with the new settlement between Visa and MasterCard and all the merchants, we do have some slightly loosened up ability to offer surcharging and discounts based on different cards that are using. And if you've parsed the settlement in detail, which Simon, I know you have, you will know that the rules for surcharging and discounts are very different depending on, is it a credit card? Is it a debit card? In the case of surcharging, you can do it for different types of cards, but you can't necessarily do it on an individual issuer by issuer basis. Whereas for doing discounts, you can do it in a little bit more granular fashion. But if you're doing discounts, you need to be able to display the different prices that are going to be options for customers in the store for every single item that they might buy. So the meta takeaway I had from that was that, and you know this very well, Visa and MasterCard are freakishly smart about this stuff, right? And so even when they lose, right, and this was sort of seen as a loss for Visa and MasterCard, they lose by just the right amount to give something to the folks who are trying to win without actually really giving up any ground meaningfully, right? And the way I read those rules and all of the sort of details around surcharging and discounts basically was they've made it kind of practically impossible for merchants to really take advantage of this in a major way, right? And so I've been thinking about what are some ways that you actually could operationally take advantage of this new set of available choices that you have as a merchant. And one of the things I was thinking about is in an e-commerce context, it's much easier for you to be able to dynamically display different prices for things, right? In a store, it's really hard to go have 19 different prices for every single item on a shelf in a store. That doesn't make any sense. But in an e-commerce context, it might be more doable. So the theory I'm sort of noodling on is, what if you could offer consumers a plugin that goes in their browser where they connect their cards? And so you can see all of the different cards they have, type of card, issuer, all the details that you need. And when they go to an e-commerce website and browse around, it is with that browser plugin enabled, dynamically displaying their different prices based on the different cards that they could use. And so you're starting to create a different sort of more personalized shopping experience for consumers. And I think you could even go a step further in tying in open banking, because open banking, the way that it's going to work in the US, at least according to the draft rule, is it does include rewards details, right? Credit card issuers are going to be forced to share details on their reward programs if consumers require that. So you could even plug in open banking to get the details on their rewards programs such that you could basically show the consumer a choice and go, okay, if you buy this thing, you have 4 cards loaded in here. Here are the different prices for this thing based on the different cards you have. And if you don't want to use the lowest cost card, here are the rewards you could get because this would fit into your rotating categories this month for your Chase Sapphire card. So it would allow for a much more dynamic user experience. And I think with a browser-based plugin, you could actually enable that fairly broadly from an e-commerce context. So that's my idea.
Interesting. There are a bunch of laws, Sale of Goods Act, Consumer Duty is a rule from the FCA that would make some of this incentivization not possible outside the US. The US seems to be going to the opposite extreme, though, which I don't know if you saw that Uber has just added Pay by Bank.
I did see that.
And they are offering you 40% off 2 trips when you pay with your bank account using Link. And of course, it's Stripe Link. And I got to say, whilst 2024, I've been saying will be the year of Pay by Bank, I thought it would be for Plaid and Trustly. Stripe Link is everywhere.
It is.
It's popping up because they're doing the same thing, but at the merchant level, they're giving all of the incentives at checkout because they see this coming and they know they can get in front of it. So hats off to those guys for seeing this one coming. But there's already the screenshot going around of all of the checkout buttons. Are you going to use Shopify Pay, Amazon Pay? Are you going to use Klarna? Are you going to use Affirm? Are you going to, oh my God, the PayPal button? There's so many buttons. And now you're going to have a plugin saying, well, if you use this card with this button, I'm like, oh my God, no. I just want it to go away. I just want to buy the thing and I want to leave. Stop giving me choices. I don't necessarily want to optimize this particular purchase right now. And so much of what's happening is with Link and with Shopify Pay and the XPays is trying to get in front of that decision. It's almost like you've landed there. You've said to us before you want to use us, right? Do you just want to click pay? It's done. We'll deliver it to your house. And I think that's where ultimately this is going is the incentives will drive you to a different default for different merchants at a given time. And the issuer is going to lose a little bit of control. Ultimately, the merchant starts to gain control because at checkout with the incentives, you can steer user behavior. I mean, it worked for BNPL. I suspect it could work for everything else as well. I wonder how much a plugin can fix that outside of the people that were using like the Honey app, which is now over at PayPal, to try and collect that discount reward. Like, there is a segment of the market that really cares about this stuff. But outside of that, the cognitive load of having to pick a card based on like what I might get and what I might not get. But then this is I'm British, I'm not American. I don't get this like, I can save a tiny, tiny piece if I use this one of the cards.
I'm with you. And I think the other thing on this is that my brain's wired exactly the same way. But I do wonder if you could just, even if it was like a single card, like do this thing, and everywhere you go and shop, it's just going to show you a lower price than they otherwise would show you. Like, you could make it simple and streamlined in a way, because the problem is with this stuff, there is no way for merchants to easily figure out what card you're going to use, right? And so to your point, like a lot of these new sort of rules or freedoms that merchants have, they're kind of practically useless because you don't know until they get to checkout what card they have or what card they want to use. But if you could find that out earlier, and it could be because they're a returning customer and they have an account, it could be via this like browser plugin, it could be through a number of different mechanisms. But if you know not just who they are, but what card they use, you could change their experience in a way that I think would potentially be beneficial. Now, to your point, I have always been of the theory that most merchants that aren't Walmart and Target and Amazon really don't care about saving a couple of basis points on their payment processing costs. They want you to buy more stuff. And so I do think BNPL sort of demonstrated that the number one value prop to most merchants is help me sell more stuff, help me increase my conversion rate. And so I think this isn't necessarily going to be something that you're going to see everywhere, but I'm just very intrigued by how it might play itself out.
Yeah, dynamic pricing is underused, and could we use it more? With the broader principle, completely agree. So I'm going to manifest a thing very briefly.
Yep.
And this is kind of a hodgepodge of thoughts here, but the video gaming industry is a mess right now. You have the very big studios that are struggling to put out one, maybe two AAA games per year. Ubisoft just put something out that has absolutely tanked because everybody's trying to do live service.
Right.
Everybody wants to be Grand Theft Auto. They want that sort of like billions in revenue from people who are always staying in the game.
Yep.
And what you're doing is you've kind of created this barbell now where you are one of the hits, or you're Fortnite and you're Grand Theft Auto and you're Minecraft, or you're not. And maybe there's this like blockbuster God of War type of like experience thing, but they're getting rarer and they're getting more expensive. They're costing more than some movies to create in many cases, and they can make a lot more money. Like the revenue the video gaming industry has dwarfed the movie industry, like by 10x. It's massive.
Yeah.
And that's even if you exclude mobile. So this is a massive, massive industry. And then you got the indie games, of which there are 50,000 games added to Steam on a given month. Like, it's just an absolute crapshoot. It's a lottery. But if you make it big, then you can really make it big. But what's going to make it big? Now, funding has pretty much dried up for this market, and there's been a lot of job losses. There's been a whole bunch of stuff going on in the industry. And yet, culturally, it's almost never been more relevant. It's never been more top of mind. So the quality of the product is going down. The acceptability of it is going way, way up. This is a market that fundamentally isn't growing because there's a supply issue, not a demand issue. And that's really, really weird. And there are two ways to get funded. The traditional studios who are pulling back, the publishers, are pulling back. And now there's like venture capitalists where you have to give up a bit of your firm, but you might make it, you might not, but how well do they understand your business? What's missing is like studio financing.
Yeah.
Like actually the debt product. And this has been very hard. I've seen a few people try and not really succeed. I don't know what the underwriting would look like. But if somebody could crack this, you would do really, really well because the demand for financing is there. Now, obviously, with debt, demand is never the issue. You would need to figure out how you underwrite it and what good looks like and It's somewhere between venture and sort of publishing. In the middle is what I would consider like venture debt, but for something different.
Yeah.
And so the people who are good at venture debt should be good at this on some level. You follow it around, you go to the VC funds, you go to the publishers, and you become a part of that ecosystem. Maybe that's already happening. I don't think it is. I've spoken to a few people. I'm not aware of it happening, some industry insiders. But I think there's something here. I really do. I would love that to exist.
I like it. I think that makes sense. It's funny you say that because I do think there is, to your point, this big gap between VC as a model for funding it versus sort of big studios or sort of like existing institutions funding it. Like there is this like huge gap in the middle, and it exists because distribution has gotten easier, right? And so like ironically, like with Steam and with these other things, like we've solved the distribution part. So before there was a natural forcing function of you could only have so many games because there were only like 5 companies that produced games and distributed games. And so like distribution was the bottleneck.
Yes.
And that meant that like from a funding perspective, like there was no gap in funding because anyone who made it to that bottleneck, they were going to get funding to build Mario Kart or whatever it is they were building. And now we've solved that distribution problem, and you can distribute a game very, very cheaply and very easily. And so there's all of this like demand. And yet the problem is, to your point, supply and be able to fund that supply. And I do also think a lot about, you see this in private credit, there's so much just liquidity out there that's just looking for a return. And there actually aren't, outside of venture debt and a few other categories, there aren't enough like mechanisms built to channel that demand for return sitting outside the traditional financial industry into areas where it can be productive. So video games seem like a promising one. I like it.
Yeah, somebody somewhere might be working on that. And if you are, get in touch because I want this thing to exist. And technically it's very buildable. There are lots of lending nerds. I know lots of video game nerds. The pieces of the puzzle for this are solvable.
Yeah.
So manifesting.
Okay.
This was so fun.
I love it.
I love a manifest.
I love it. No, it's awesome. It's a fun note to end on. Simon, as always, a delight, sir. Thank you. This was very optimistic, despite the sort of gloomy weather here. And let's do this again next month if you're game.
Let's do it again. Thanks for having me.
All right. I appreciate you.
Take care, dude.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.